Listen to me, because this is your life and this is your money we are talking about. You have worked 40, 50 years to build a nest egg, and you cannot afford to be reckless with it now. I know you're looking at the headlines, I know you're seeing the Federal Reserve playing tug-of-war with interest rates, and I know you are scared. You're scared that if you leave your money where it is, inflation is going to eat it alive. But you're also scared that if you lock it away, you won't have it when an emergency strikes. We are in May of 2026, and the game has changed. For the last couple of years, you enjoyed those 5% returns just by sitting on your hands. It felt good, didn't it? But look at the screen. Rates are sliding. We're seeing top high-yield savings accounts and CDs hovering around that 4% mark, and the experts are telling us they could go even lower by the end of the year. So the question you're asking me, the question that is keeping you up at night, is, Susie, where do I park my cash so I don't lose my shirt? First, let's talk about the high-yield savings account. I love the flexibility here. In retirement, liquidity is your best friend. If the transmission goes on the car or the roof starts leaking, you need that money now. You don't want to be asking a bank for permission to spend your own money. But here is the problem, these rates are variable. That 4.2% you see today? That is not a promise. It is a for now. If the Fed cuts rates again next month, your bank is going to send you a very polite email telling you that your yield just dropped. If you are living off that interest income, a drop from 4% to 3% isn't just a number, it's a cut to your monthly budget. That is the fear. Now, let's look at certificates of deposit, CDs. Why are people talking about them so much right now? Because a CD is a contract. When you put your money in a 12-month or a 2-year CD today at 4%, the bank cannot take that away from you. Even if the economy shifts and savings rates plummet to 2%, you are sitting pretty. You have locked in your peace of mind. But, and this is a big but, you are trading access for that guarantee. If you put $50,000 into a 5-year CD because you wanted to lock it in, and 3 months from now you have a medical emergency, you are going to pay an early withdrawal penalty. And in many cases, that penalty will eat up all the interest you earned and maybe even a bit of your principal. In retirement, we do not touch our principal. So, what is the actionable takeaway for you right now, in 2026? You have to stop looking for one perfect place. There is no one-size-fits-all. You need a strategy that protects your now money and maximizes your later money. I want you to look at a CD ladder. This is how you win in a falling rate environment. You don't take all your cash and lock it up for 5 years. No! You break it into chunks. You put some in a high-yield savings account for your emergency fund, that's your 8-month or 12-month security blanket. Then, you take the rest and you spread it out. A 6-month CD, a 12-month CD, and maybe an 18-month CD. Why do we do this? Because every few months, a rung of your ladder matures. You get a chunk of cash back. If rates have gone up, you reinvest at the higher rate. If rates have gone down, you are so happy you locked in those other chunks months ago. It gives you the best of both worlds, the security of a fixed rate and the liquidity of cash coming due. I also want you to be very careful about where you are keeping this money. If you are still keeping your parked cash in a traditional big brand bank earning 0.01%, you are committing a financial sin. You are throwing money away. Go to the online banks. Look at the institutions that are FDIC insured, that is a must, no exceptions, and find the ones offering 4% or better. The fear of missing out on the perfect rate is standing in the way of you making progress. If you have $100,000 sitting in a checking account doing nothing because you can't decide between a CD or a savings account, you are losing hundreds of dollars every single month. Decide today. How much do you need for an emergency? Keep that in high-yield savings. How much can you leave alone for a year to protect your income from falling rates? Put that in a CD. You have to be the master of your own money. Don't let the banks win by being lazy. Lock in what you can, keep what you need, and stay safe. Because you deserve to enjoy your retirement without worrying about every tick of the interest rate clock.